Hi everyone, good morning. Today we'll be starting with discounted cash flow question and answers. This is the basic question and answers, and there are 32 questions in this reading. And previously we have completed the valuation advanced questions. So let's get started. So today, before we start the session, discounted cash flow, I just wanted to give you a quick review of how does a discounted cash flow looks like. So here, if you can see my screen, so a discounted cash flow model looks like this. Uh, these are the actual numbers. 2018 onwards, for 5 years, these are the forecasted numbers based on 2017 numbers. Using the reference of 17, we have forecasted 2018 numbers. Using the reference of 2018, we have forecasted 2019 numbers, and then 20, 21, and 22. And using this 22's reference number, this number, we have forecasted terminal value. Terminal value, we are assuming that company will be in business forever, and the terminal perpetual growth rate is 4%. And the formula for terminal value is the Gordon growth formula, Gordon growth rate, which is free cash flow at the time n. We multiply it with the growth rate, and then the discount rate, subtract the growth rate. So this is the Gordon growth formula, which is also the terminal value formula. So for terminal value, the reference time, the free cash flow is actually the nth free cash flow is the last free cash flow. So using this, uh, taken, we have calculated the terminal cash flow, terminal value of the free cash flow. So basically, here what we have done is we have calculated these numbers. We have calculated our EBIT, our tax numbers, our the depreciation and amortization, and our capital expenditure and changes in working capital number. We have forecasted these numbers to get our unlevered free cash flow. And the plugins for to forecast these numbers, we actually have used the previous data and we have tried to find out a trend. And then we have forecasted these numbers based on the trend and assumptions. So assumptions are different thing, and we are here only talking about the rates which are used, how these numbers are calculated. We are not talking about these. So this is a long that will be a long process. So just to give you an overview, we will do question and answer. We will do actually a DCF model of all some companies or a couple of companies from every sector later on, as discussed previously also. So this is how a DCF looks like. So tax rate, we have assumed tax rate. We have calculated a discounted rate on the basis of working weighted average cost of capital. This is a perpetual growth rate. In this, all these numbers and these assumptions are actually, which you can see, these are in blue. This 8x is actually market multiple, enterprise value to EBITDA multiple, which is comparison of peer companies. During valuation, uh, we talked about trading comps. So this actually came from there. Perpetual growth rate, we have calculated this, or we have assumed this based on the condition of economy's growth rate. So perpetual growth rate is from there. Discount rate, weighted average cost of capital, the cost of debt and cost of equity. So on the basis of this, we will calculate weighted average cost of capital in next few questions. And tax rate, the company's previous year's record and the future assumptions has help us calculate the tax rate. So using this information, we have calculated these. So see what happens here is, so Unlevered free cash flow. So if you remember, we talked about it. Unlevered free cash flow is actually the cash flow which is available to both debt and equity holders. We have talked about this, and the levered free cash flow is only available to equity holders. Why? This exclude interest, and it includes interest. So unlevered here, unlevered free. We use unlevered free cash flow to calculate the during the DCF. We use an unlevered free cash flow. So see, just follow the formula. So just like the formula, it's calculated here in the screenshot also. So from EBIT, we have calculated EBIT. We have subtracted the cash taxes. This means one minus tax rate. So from EBIT, we have subtracted the taxes and we have added. So this has given us no PAT income, net operating profit after tax. Then we have added back depreciation and amortization, D&A, and this has given us EBITDA. So we are going actually up. We are going backwards here. And then we have added capital expenditure. Oh, sorry, we have subtracted capital expenditure and we have subtracted changes in net working capital. And this has given us our unlevered free cash flow. So we have calculated based on our assumptions the unlevered free cash flow for all these years. And then what we have done is we have calculated our terminal value based on the last forecasted period. Now we have discounted all these values back to today, 9/30/2017. This model was built on 9/30/2017. So we have discounted back all these amounts. So we have discounted this by 1 quarter. We have discounted this by 1 quarter and 3 months. We have discounted this by 1 quarter, sorry, 1 year and 1 quarter. Here, 2 year and 1 quarter, 3 year and 1 quarter, 4 year and 1 quarter, 5 year and 1 quarter. And this we have discounted perpetually. So this is the enterprise value. This we have calculated enterprise value based on the discount rate. Here, if you can follow the arrow diagrams also, this we have discounted back to this date, 9/30/2017, and when we will discuss about when we will do a DCF model, DCF of a model, then we will talk about these dates also. How do we? So every day we can discount. So for we cannot skip not even single day. We actually have to discount it back. And after enterprise value, how do we get the equity value? If you remember, so if uh, if we actually have the equity value, we will add back the cash because that can be subtracted to pay off the debt. But in when we are calculating our enterprise to equity value, what we will do, we will add back the cash and we will subtract the debt using that cash. This will give us the equity value. So don't get confused in using the formulas. And when we divide the equity value by the number of shares outstanding, so it will give us the equity value per share. So this is how a DCF looks like. The main the main requirement of a DCF is you have to remember the unlevered free cash flow. Just remember the formula for free cash flow to firm. And this is called free cash flow to firm because in a firm, both debt and equity holders, all investors come into play. And when we are talking about free cash flow to equity only, we are only talking about the equity holders. So never get confused about unlevered and levered. Unlevered and levered. So I hope this is clear. These are the assumptions here. Assumptions 1, 2, 3, and 4. We have assumed based on the market data 8x, and the current market price of the share is 17.3, and the outstanding shares are these. So this has given us that our stock, the company of our interest is actually We have calculated the fair market value as 16.94, and current market value is current price is this. So we can make assumptions that the share is trading above. So it's overvalued actually. Uh, Two things to remember: terminal value formula, unlevered free cash flow formula, and that we actually have to discount everything back to the present value. So we'll get the enterprise value of the whole company, and then we will find the equity value. We will add back cash, we will subtract debt, and we will get the equity value. We will divide the equity value by the total number of shares. This was a pretty much simple example. It's just so that you could understand how does a DCF look like. Major time consuming parts of a DCF are actually forecasting these numbers into future, making assumptions, the finding out the trend and all, and then making your model representative, how slicers and all, putting in slicers and filling in all the colors, make it representable. So that actually takes a time, and collecting this data, high quality data. We have talked about everything in the previous questions. Uh, One main reason might be the market conditions. If the market is in boom, the stock prices would have been high. If the market is in recession or downturn, the stock prices are. So there could be major, and I mean there could be n number of reasons why our stock has come out to be as overvalued. So just remember this this diagram. To value the business, we discount all the cash flows, each year's cash flows, terminal value, discount each year to the current year, to the is exact date, to the exact quarter. So here we would have discounted it for 1 quarter. Here we have discounted it for 1 year plus 1 quarter, 2 year plus 1 quarter, 3 years plus 1 quarter, 4 year plus 1 quarter, 5 years plus 1 quarter, and date to date. This time onwards, we have exited here, but perpetually in the future, if the business is still running, this is the value, and we have discounted it all here. To understand the perpetual growth rate, you actually have to understand the economy also. Every year, your economy also grows. Economy sector. If a company still keeps on, if the company still keeps on reinventing new things and keeps up to date with the new trends, then perpetual growth rate is. And we do not take position more than 5 years, because in 5 years the industry trends changes actually. We have talked about that also. So, all right. So I hope this is clear. Let's get started with the Q&As without wasting any time further. So I hope this will be a good start for us. So discounted cash flows, Q&As. So the first question here is, walk me through a DCF, and I just did walk you through a DCF. So uh, the discounted cash flow analysis values a company based on the present value of its future free cash flows. And the core idea is that the business is worth the cash it generates for its investors, and given that it discounted back to its today's value. And the process starts with projecting the company's financial performance, and typically over a period of 5 to 10 years. So let me just show you one more time the example, the diagram. So typically for a period of 5 to 10 years, and you begin by forecasting the revenue, and you then build the assumptions for operating expenses, margins, taxes, uh, and changes in working capital to get unlevered free cash flow. So here we have not we so calculate so we have, from revenue we have subtracted the cost of goods sold, and we have subtracted other expenses, and we have received the EBITDA here. So we are not starting from revenue, but we are starting from EBITDA here. So don't get confused. And so once you have projected those cash flows, these cash flows, the next step is to discount them using the company's weighted average cost of capital, which is a discount rate. Uh, And weighted average cost of capital represents the cost of equity and debt financing and reflects the required rate of return for investors given a company's risk profile. What is a discount rate? Now, if you think about it, discount rate is also the required cost of capital also. So the company is actually having this. So give there is a there so although investors are getting at least 12% of the from the company. So given this is the company actually has to beat this. So the equity given this much amount discount. So the share value is has come to 16.94. But this is the minimum case. So above this, how much better is the valuation? That's the whole question. So this is a threshold actually. So this is below threshold. 16.4 is the threshold, and we are slightly less than this threshold. So what the market is trading at, that the stock is trading in the market is 17.3. So we are below the threshold. We actually have to beat the threshold. We actually have to do something so that we are overvalued in the market, or we are actually fairly valued. This could be one more case that the company is fairly valued given on the market conditions, and the market is actually efficient market. All the investors are aware about the current trends and know, and all the public information is public. No private information is used. So this could be one more scene, one more scenario here. But discount rate is actually it represents blended cost of equity and debt financing and reflect the required rate of return for investors given the company's risk profile. And after you discount all the forecasted cash flows, you need to account for company's value beyond that explicit horizon, which is the terminal value. And there are two main methods to estimate that. Gordon growth, we have discussed about this. And there is also one exit multiple method, which we will discuss later on. And it actually applies an industry multiple. So enterprise value to EBITDA, we multiply it with enterprise value to EBITDA of that company. We multiply with the enterprise value to EBITDA to companies for projected terminal year financial metric based on comparable companies. And once you have calculated terminal value, you discount it back to the present value. And finally, you sum of the present values of all. So you sum up the present values of all the projected future cash flows and discount them to arrive at the enterprise value here. And to get the equity value, you adjust them for the non-operating items. You add the cash, you subtract the debt, and any other claims like preferred stock or minority interest. Also, so here we can also subtract minority interest and preferred stocks, and then you divide it by the fully diluted number of shares count, and you get the implied share price. So overall, if you think that DCF tells you about the what's company's worth today purely on its ability to generate cash in flow in the future. So if the economy is doing well, there will be changes. And if the cost of capital reduces, this number will get bigger. That would be so reducing the cost of capital will be good for us, and increasing this number will be good for us because if the economy grows, the terminal values grow, and that will actually update our assumption, update our valuation, and we will get a better value, better equity value. And an analyst actually, that's why the analysts actually keep on tracking the economy. That's why analysts keep on tracking the economy, the businesses, the governments, um, uh, and also their business partners, their customers. If you are if you are from the United States and you are selling something to Canada, that's one thing. So if you are selling something to Canada, so you are 70% sure that next year they will pay you the money. But if you are selling to if you are selling to a country like Somalia, So you are not sure whether or not you will be able to generate the get those get revenue from those countries, because based on the economic and the political environment of those companies, or let's say Pakistan, or let's say Afghanistan, where war is happening, or let's say not these countries, but think about Palestine, so or Israel or Ukraine. If those are your customers, your sales are going to get hit, and that's why economies need to be stable. The world economies only work better when there are no countries are fighting. So let's not talk about that in detail now. Right now, we will discuss. Let's discuss. Stay on the topic. So I hope this is clear. Uh, DCF. This walk me through a DCF. This is how a DCF looks like, and this is how we go through a DCF. Uh, let's talk to question number two. Walk me through how you get revenue from free cash flow in the projections. So basically, if you want to get to free cash flow in the projections, you actually start with the revenue. Subtract cost of goods sold. Then you get EBIT numbers. You adjust for taxes. So this is again here only. So this is the question is asking about revenue to free cash flow. So revenue to free cash flow. You get from revenue, cost of goods sold are subtracted, and other operating expenses. Then you get the EBIT numbers. Then you adjust for taxes. You get NOPAT numbers. You add back non-cash expenses like depreciation, amortization, and other cash expenses. Then you get the EBITDA numbers. You subtract the capital expenditure numbers. You adjust for working capital changes, and then you get the free cash flow numbers. This exactly formula from revenue. They are asking about from revenue, and we are here talking from the EBIT perspective. So to generate EBIT, we have done revenue minus cost of goods sold and other expenses, and we have generated EBIT. I hope this was clear again. So question number two, we have discussed. Let's talk about question number three. So another um, alternative ways to calculate free cash flow, aside from taking net income, adding back depreciation, subtracting changes in operating asset liabilities and capital expenditure. And one common method of free cash flow is to start from net income. We so if we are talking about net income, where is my Excel? Okay. So if we are calculate, we earlier we were doing it from EBIT, but if you talk about from net income, you actually take it from here. So one more common method to calculate free cash flow to start from net income is to add back the non-cash charges like depreciation and amortization, and you adjust for changes in working capital here, and you start from cash flow from operations. And if you remember the formula given here in the example, depreciation, capital expenditure, changes working capital, this could all be considered as cash flow from operations. So from cash flow from operations, if you subtract capital expenditure, so capital expenditure is PPE. So you get basically so from CFO, if you subtract cash flow operation, you get a basic measure of unlevered cash available to the firm's investors. And if you subtract mandatory debt also, debt repayments, you arrive to levered free cash flow. So you will arrive at levered free cash flow here. So net income, depreciation, and this uh, net changes in working capital. And once you have done that, you subtract the capital expenditure and net borrowings, you will receive uh, uh, levered free cash flow, and to step further and to go a step further to calculate unlevered free cash flow, which reflects the cash available to all capital providers, independent for company's capital structure here. You adjust for financing related items, you add back interest expense. Interest expense will be added back into this. This will be the component. Adjustments remove. Uh, so this method particularly is useful in valuation scenarios where we are actually uh, discounted cash flow. And this is actually particularly useful in discounted cash flow analysis because unlevered free cash flow allows you to model cash flows independently of financing choices, making them directly comparable across companies with different capital structure actually. So from net income, if you start, so you will get the levered free cash flow, and from levered free cash flow, you can adjust for tax adjusted interest expenses and subtract tax adjusted interest income. This will give you levered free cash flow. And uh, just give me a moment. I am sharing the formula here. And this I will be sharing. Just give me a moment. So levered free cash flow. I'm sharing the formula here. I've got the formula. So from free cash flow, from cash flow to operations, if you subtract the capital expenditure and mandatory debt repayments, so you will receive levered free cash flow. And into levered free cash flow, if you add back after tax interest expense and you subtract after tax interest income, then you will get unlevered free cash flow. So you actually need to remember this because at times these numbers are provided to you, not simpler numbers, or you actually have to calculate these numbers. After tax interest expense into 1 minus tax rate, and after tax interest income is interest income into 1 minus tax rate. And this will be helpful for you to understand this thing. All right, let's move to question number 4 now. I hope this was clear. Why do you use 5 to 10 years of DCF projection only? So when you are performing a DCF, we typically project cash flows from 5 to 10 years period only because that's generally a time frame over which we can make reasonably accurate assumptions about a company's operations and financial performances also. So projection shorter than 5 years may not fully capture the impact of companies' strategic initiatives and capital investments or business cycles. So business cycles and capital investments, because see, if you are today doing a capital investment and the capital investment is going to take a considerable amount of time to start generating cash. So capital investment, strategic initiatives, if you have done a strategic initiative, then it is going to take a time a considerable amount of time to start monetizing, and so does the business cycles also. So business cycles comes and goes. Some businesses are cyclical in nature, and this can result in incomplete valuation if you don't look at 5 to 10 years of data. Uh, so And on the other hand, projecting beyond 10 years tend to introduce a high level of uncertainty also, because factors such as market dynamics, technology changes also, regulations also change there, and competitive behaviors become increasingly difficult to predict, because a lot of other companies also get into the business, and making long-term forecasts is less reliable also. So by using a 5 to 10 year horizon, we strike a balance between providing a meaningful and actionable forecast and maintaining credibility in our assumptions. So after explicit forecast period, we can apply a terminal value to account for cash flow beyond that horizon. I hope this was clear. So why we use a 5 to 10 years of DCF projection? Talk about question number five now. So question number five, what do you usually use for discount rate? And discount rate, we have discussed previously that we use weighted average cost of capital. And in DCF analysis, discount rate is rate is critical because it reflects both time value of money and the risk associated with the cash flows. Okay, so when we were discussing previously, so time value of money, that was the term which I was not able to recall. Time value of money factor, because of time value of money factor, uh, and the risk associated with the cash flows. So discount rate is critical actually. So typically we use weighted average cost of capital as a discount rate. The weighted average cost of capital actually incorporates cost of equity and the after tax cost of debt and weighted by company's capital structure, which gives us comprehensive view of overall required return for the firm investors. And the rationale is that the weighted average cost of capital represent the opportunity cost of all sources of capital, making it appropriate when discounting the firm's free cash flow to firm, so FCFF. And however, if you are valuing equity cash flows specially, so like free cash flow to equity, it is more appropriate to use cost of equity as a discount rate, since those cash flows accrue only to shareholders. So if you are calculating free cash flow to equity, then use the equity cash, I mean the cost of equity as a discount rate. And ultimately, the choice of discount rate depends on how the cash flows are actually defined and the risk profile of the businesses or projections. And the goal is always to match the rate of risk and type of cash flow. So the valuation reflects the true economic value for investors. The discount rate. And in next question, I think we will be calculating how the weighted average cost of capital is calculated. Just so you are, if you're learning about finances, so just remember these few terms: time value of money first, and opportunity cost. Time value of money, opportunity cost, and risk. So time value of money, opportunity cost, and risk. If you are using a discount rate, these three parameters should apply to that. So time value of money, if I am asking you to put it in your bank, and if you're generating more return in your bank than investing it somewhere else, so time value of money and opportunity costs come into play. So opportunity cost is if you can generate more revenue using that money, or if so, and let's understand, if you are a working professional, or if you are thinking about going into business, so what would be the opportunity cost? Your salary, every month salary would be an opportunity cost, because you will be letting go of that salary for the risk you will be having in the business, or the reward which you are uh, sure that you will generate in your business. So that's opportunity. And the third concept that comes into play is the risk associated with it. So more the risk, if you're using higher discount rate, so that represents high risk. So if you go to different banks, or if you have ever seen different securities, so every security, every bond, let's assume bond, so every bond or every security has a different interest, every security has a different rate of return. So more the rate of return, that means there are factors which actually There are factors uh, which using which interest rate is actually calculated. So those factors are actually in theory. Yeah, in theory, if I tell you, they are uh, uh, they are actually linked. Linked will be the not linked, but something around that. So maturity will be a factor, liquidity will be a factor, uh, inflation will be a factor, and so all these components, when you add them up, then it will bring then it will bring get you a rate. I'm not able to recall all those factors which actually are in the are used in the calculation of a rate. So let's stay on this topic only. When we will discuss about the industry, or when we'll do a DCF or other valuations, then we will discuss about those factors. So let's go look more. Let's move to question number. You can please Google that. Please Google that. So what are the components of an interest rate? Liquidity, maturity, etc. So just give in a few of these, and they will actually find it out for you. Uh, let's move to question number 6. So how do you calculate a WAC, a weighted average cost of capital, and commonly known as WAC? So here it's given. So the weighted average cost of capital actually represents average return a company is expected to provide to all its capital providers, equity holders, as well as weighted average cost of capital. It includes equity and debt both. And after, just remember this thing: whenever you find debt, just remember after tax debt, the cost of after tax, after the tax has been paid. Whenever you get debt, you actually have to pay tax on that. So represents average return on a or return a company expected to provide to all its capital providers, equity holders, debt holders, and preferred shareholders also. So preferred shareholder component also comes into play if the company has a complex capital structure. Easy capital structure, it has actually has it doesn't have preferred stocks. So when you there are preferred stocks also. So the stocks also gets diluted. So dilution or all those things also comes into play. That's called a simple structure and a complex structure. So weighted average cost of capital is actually cost of equity into percentage of equity in the company. So out of 100, if this number is 20%, this number is 20%, and this number is preferred stock is 60%. So 20, 20, 60 is 100%. So that's how out of 100 of a slice, out of 100%, how much is the equity out of 100%? After equity, we have allocated something to equity. We have some allocated something, some percentage to debt, and we have allocated something to preferred stock. And percentage itself means it's out of 100. So out of 100 equity means out of percentage equity means something out of 100, something out of debt, and something out of preferred. And all these three, when you add up equity, debt, and preferred stock, it should be it should sum up to 100%. So cost of equity reflects actually the return required by equity investors for taking the company's risk, and the most common method is to calculate it using cost of equity. And cost of equity, the formula for cost of equity here is the most common method is actually CAPM, capital asset pricing model. So which factors into risk-free rate and company's beta and the market risk premium. So market risk premium is, and what is risk-free rate? So risk-free rate is actually the government bond rate. So if you put your money in a government bond-free rate, that much is the government giving you, and above that rate, risk-free rate, market premium is how much above that risk-free rate you can make the market premium, not market return, market premium. This is the formula for, uh, we'll discuss the formula later on. I think we do not have the formula. Okay, this is the, no, not even this is the formula. This is not the formula. This is not also not the formula. Let's not get confused. So we will talk about the CAPM. I will show you. So CAPM, CAPM, capital asset pricing model. So cost of equity is calculated using capital asset pricing model. Cost of debt is calculated using cost of debt is easy. So you just subtract the taxes, you multiply it with the percentage of debt, and cost of debt can be easily found in the company. So cost of debt is the effective interest rate a company pays on its debt, and since interest payments are tax deductible, we multiply the cost of debt by one minus tax rate to account for tax shield. And we usually estimate this by looking at yields on comparable debt or company's current borrowing cost. And preferred stock is the return required by preferred shareholders, and it's typically calculated as preferred dividend divided by net issuing price of preferred stock. So dividend yield on a preferred stock, that's what it is. So dividend yield is preferred dividend divided by net issuing price of the preferred stock. So that's yield. So if I am paying $10 on $100 um, preferred stock, so $100 was the issuing price, and we are providing $10. So 10% is the cost of preferred stock. We multiply it with the weight of preferred stock, cost of preferred stock. We multiplied the percentage of preferred stocks, how much percentage um are there in the company's capital structure. And so the intuition around WACC is often that as a discount rate in discounted cash flow analysis because it represents the minimum return a company must earn to satisfy its investors. And that's what I was actually talking about here. So let me just show you one more time. This is the minimum discount rate is 12% is minimum, and this 12% is calculated using weighted average cost of capital. So this is what I was referring to. So at least this much. So the company, if we are the least scenario, if after the least scenario we are getting this much and our company stock is undervalued, so we actually dig deep into why this is happening. At least they actually have to earn to satisfy all the investors, and lower WACC suggests cheaper financing. While a higher weighted average cost of capital indicates that the capital is more expensive due to higher risk. So more is the weighted average cost of capital, more will be the risk in the company. So that's being said, question number 6 is done. Let's move to question number 7. And today we will only try to complete 10 questions of the reading. So question number 10, how do you calculate the cost of equity for a using capital as a CAPM? So cost of equity, we have discussed. The cost of equity is risk-free rate plus beta into equity risk premium. So risk-free rate is usually the yield on a long-term government bond, 10 or 20-year US Treasury bonds, which represent the return investors will expect from a risk-free investment. And the beta is actually this company's systematic risk relative to the market, and it is often calculated based on comparable publicly traded companies in the same industry. And also, if you have the company's data, company's daily stock price data, and the market's opening and closing data, we can calculate beta also. So using Excel, we can calculate beta. And uh, somewhere around in next session, we will try to calculate beta. And the equity risk premium. So equity risk premium, this reflects actually additional return investors expect for taking on risk versus risk-free assets. So, and it's worth noting that CAPM, capital asset pricing model provides a baseline estimate in practice. Especially in investment banking or equity valuation, you might also add adjust for size premium or industry premiums also. So CAPM only gives you a baseline. So you can add for size premium or industry premiums in those in this rate also. So this is the simple formula for capital asset pricing model. You risk-free rate, government risk. If this is 10, if this is 10, beta is 1, and equity risk premium is 5. So 10 plus 1 into 5 is 15%. So cost of capital equity will be 15%. So let's go to question number 8 now. So how do you get to beta in a cost of equity calculation? So to calculate the beta, the cost of equity, the goal is to quantify the systematic risk of a company relative to the market. And since beta is influenced by both the businesses and company's capital structure, the process involves isolating the underlying business risk first and then adjusting for the target company's leverage. So what does this means is if you have, let's assume that you are working on a company which do not have, okay, you are working on a private company and you are based on the same peer company analysis, you are using that company's beta. So here you will unlever the beta and then you will lever the beta. Then you will use that beta in the other company. You will relever the beta. You will unlever the beta first and then you will relever the beta to calculate the CAPM of a company which do not report out its beta, or you do not have that much data to calculate the beta of that company. So you start by identifying a set of publicly traded companies here in this in this, I mean, that are operationally similar to the company you are valuing and similar to industry scale and geographic exposure. So that actually need to pay attention to peer companies. Then you collect this beta and you pull observation. This is the formula. How you do this? Lever, unlever beta, unlever beta. So this is the formula to lever the beta, unlever the beta. So you divide it. This is the levered beta which you are using. You will unlever it. You will multiply it 1 minus tax rate of that company's data. Then you will get a unlevered beta. And you will use that unlevered beta to calculate uh, the beta for that company. And this approach actually ensures that beta reflect the inherent business risk of the company while also capturing the impact of capital structure. So it's considered back practice. This is the best practice method in valuation because it balances market-based evidence and company-specific factors. So beta is, if you talk about beta, so beta is actually your stocks, your company sensitivity to the sensitivity of the market. If the markets are doing good and your company, your stock is doing good, so that will give you the beta will correlation. The beta will represent the correlation in between your stock and the market. So if markets are booming and your company is booming, and if markets are falling down and your company is falling down, so that means that your company is in relation with the market. So your stock is in relation with the market, and that's what the market thinks about. And this is how your stock is sensitive to the market, the fluctuations in the market. So beta represent that. So if I am valuing a company which do not report out its beta. So let's assume that REITs. Let's talk about REITs, which we have previously discussed. All the REITs of banking. So if there is a private company in REITs or in banking segment, and we are valuing that. For that, we will be needing a beta, and we will actually be needing a discount rate. Obvious, that's very obvious. So we will be needing a beta to calculate the CAPM. So capital. So we will be needing. We will need a discount rate first. So to calculate a discount rate, we will use the we will calculate the weighted average cost of capital of the company. So what we will be needing is to calculate the weighted average cost of equity. We will be needing beta, and that debt we have discussed. That debt can be the weight and the return of debt can be calculated using the debt numbers. But for beta numbers, we usually follow a CAPM approach. So uh, CAPM, to get the CAPM to capital asset pricing model, we will be needing beta. So let's assume that we are using a public company, a company which is being traded on the stock exchange. We are using that beta. We are first unlevering that beta, and the beta, because the beta will be showing the sensitivity of that industry, that sector, with represent to that with the with reference to the market. So beta will be representing that companies, that stocks sensitivity to the market, and based on that, so we will use that company which we are taking the beta of, the public company, debt and equity and all those things. We will unlever the beta using those numbers. So we will unlever the beta, we will get a raw beta, and we will use that unlevered beta to calculate our cost of capital. So understand this thing. Then we will calculate our cost of equity and the cost of debt. That's not very difficult to calculate. So just understand this thing. Why I am taking an assumption. Why I'm talking about a public company and a private company. You can get your data, this beta from Bloomberg also, or you can Google it. Any company, Yahoo Finance report out these numbers, or any you can Google, simply Google the beta of that company, XYZ company. So you can get that number. But if you are valuing a private company, you will not be able to get the beta of that company. So you will not be, that doesn't mean that you cannot value a private company. This is how you do that. If the interviewer asks you, this question is in relation to, if I am asking you, how do you value private company? So what data will you have and what data will you require? So this is how you apply these things. So I will suggest start applying rather than just keep on thinking and reading. So you have read it now. You have understood this concept. Now start applying those concepts. All right. So let's move to question number 9. So whatsoever I try, these sessions actually stretch out to more than 1 year, 1 hour actually. Uh, so let's start question number 9. Why do we have an unlevered, or why do you have to unlever and relever a beta? So beta actually measures systematic risk of a company's equity relative to the market, and in other words, it shows how sensitive the stock is into the market movement. Uh, so why do we lever and unlever the beta? So levered beta actually reflects company's total risk to equity investors, actually. Yes, and including both the operational business risk and the financial risk of the levered debt. And the companies with more debt actually have higher financial risk, which increases the levered beta. And unlevered beta, if you talk about it, is unlevered beta actually isolates the business's risk only and ignoring the effect of capital structure. And it tells you how risky the company would be if it has no debt. So the key point here is to remember that companies with different amount of debt will have different levered betas, even if their operations are similarly risky. So that's why. So every company has a different debt structure. Think about this from your perspective. So if you are a company or if you are a person, so you have X amount of debt. So initially the bank gave you 5% interest rate. But when you want more debt, so the next time the bank will say, okay, so based on your financials, we are going to give you debt, but this time the interest rate will increase. So we will be giving you a 10% rate. Okay, so you went to the bank third time also. So third time the bank said, okay, based on your financials, you already have two debt, but based on your financials now, I don't we do not think that you will be able to pay us back. So we are going to give you a debt uh, of 20. We can give you a debt, but the interest rate would be 15%. So 5%, 10%, and 15%. Now think about it. More the data company has, the more risky that company is, because the revenue, there is nothing new in the revenue. So no new income streams are going to be there. And from that income stream only, they actually have to uh, pay their interest, debt, everything. So so that's also a big universe. First, there are different structures where you first initially pay the interest only, and or you pay out your principal also. Uh, Little by little, or you pay your principal once at the end of the um, term of the loan. So that those are called balloon payments. Those types of loan are also, those type of loan also have a uh, high interest rates. So to do an apple to apples comparison, it's important to unlever a beta. So unlevering a beta will reflect, uh, the, so you will be able to exclude the the risk occurring from the debt of the company. So you will unlever it, then you will relever it based on the debt of the different another company, the capital structure of the other company. And but the reason why we unlever the beta is when performing a valuation or comparing companies, we want apple to apples comparison. And so the difference in beta is partly because of different debt levels, basically, and not necessarily because the company's business are riskier. So debt levels, and by unlevering, we strip out the effect of debt and isolate the company's true operational risk also, and giving us a clean measures to compare across companies. And reliving after the after I mean, when we relever, we apply target companies capital structure to get beta to beta to use in the cost of equity calculation. And the intuition here is, if you think about it, is the think of beta as a risk thermometer actually. So unlevering removes the heat caused by debt, so you measure the real temperature of the business, and relevering then adds back the heat that the company owns. Company's own debt contributes, giving you the true measure of the risk investors. So risk for investors. Uh, so let's move to question number 10 without wasting any time further. So I hope this was clear. Okay. So how would you expect a manufacturing company or technology company to have a higher beta? Okay, so beta is actually a measure of stocks volatility relative to the overall market. We have discussed that. And if the if beta of a stock is one, means that stocks tends to move in line with the market, and beta greater than one indicates the stock is more volatile than the market. So if you talk about technology companies, so there is, if we think about it from the perspective of industry volatility, the technology companies operate in industries that are rapidly evolving, and consumer preferences, competition, and innovation cycles can change quickly, and which can lead to larger swings in revenue and stock prices. So manufacturing companies, by contrast, often produce goods for established markets with predictable demands and leading to a more stable earning. Growth, if you think about growth or stability perspective, so technology firms are typically growth oriented or and reinvest heavily in research and development expansion. While this can generate a high return, it also exposes a company to move risk if products fail or market shift. And manufacturing companies are often more mature and capital intensive and focusing on efficiency and cost management, which reduces market sensitivity. So as compare if you compare a manufacturing company or technology company, so manufacturing company would I uh, eh, based on growth and stability, manufacturing company is much more stable than a technology company. And if you think about financial leverage and cash sensitivity, tech companies may have less predictable cash flows and higher operational leverage, which can amplify stock price movement during a market swing. And manufacturing companies usually have a steadier cash flows and due to long-term contracts and consistent demand. So mm. And thinking about from the market's perspective, if you think investors tend to perceive technology stocks as riskier because their valuations are based on future growth expectations rather than current earnings. And this perception contributes to higher beta as the stock reacts more strongly to the market sentiment. And for those reasons, technology companies are generally expected to have higher betas than manufacturing companies. And this reflects actually greater sensitivity to market movement and higher perceived risk, even if the potential returns are also higher. And yes, we would expect manufacturing company to have, in a technology company to have a higher beta. So let's wrap it up. Uh, uh, for today, I will see you in next reading. We will continue question number 11 onwards. And all the very best and try to apply these financial concepts. I hope you enjoyed today's session. Thank you.